And that's the benefit of doing the self-rental strategy is you don't have to go and run an Airbnb business. You don't have to go and qualify for real estate professional status. By making a smart investment and making a grouping election, you can perform the cost segregation study to create a paper loss.
All right, guys, welcome to another episode of The Report Saturday edition. And I got my co-host, my man, Karlton Dennis. Karlton, welcome to the show, brother.
Thank you so much for having me on. Excited to be here, man.
Yeah, dude. Excited for this episode, man. We got a new strategy that you just taught me about. And I'm as a listener, I'd be shocked if you heard about this. But
Yeah.
this is some new stuff right here. And I think it's going to change the game for a lot of folks out there. Maybe you're listening to this and you're like, hey, this might be able to benefit you. But you call it the self-rental strategy. Karlton, what the heck is the self-rental strategy?
Yeah. So as taxpayers and investors, we get excited about investing in real estate for a multitude of reasons: cash flow, depreciation, and appreciation. But the depreciation part really is interesting because many taxpayers have the ability, when performing a cost segregation study, to create what's called a paper loss, where you are cash flow positive from your investments, but you're reporting a loss on your tax returns. And whether or not you qualify for the real estate professional status, which is 750 hours and spending more time in real estate than your W-2 or 1099 job, or if you're running the self or short-term rental strategy, you're essentially showing the IRS that your real estate is an active business. And so those active losses that come from doing a cost segregation study allow for you to be able to offset your W-2 and 1099 income. But what if you're a taxpayer just finding out about real estate professional status? 750 hours in the month of August between now and the end of the year, that might push you to having to spend 30, 40 hours a week to try to get to 750
It's a
hours.
lot.
Or maybe even the short-term rental strategy.
Mm-hmm.
Buying a short-term rental or even running a short-term rental business sometimes isn't enticing to a lot of investors because they see that it's a lot of work involved to have customers coming in and out of their property every 3, 5, 7, 10 days. So then we have the self-rental strategy. And this is the elephant in the room that I want to talk about today. For business owners, they're in a unique situation where they can leverage a self-rental as opposed to having to qualify as a real estate professional running a short-term rental. And let me explain the example. Let's just say that you're a doctor, or maybe you're a physician and you have your own home healthcare practice, or you're running your business from your home. Rather than having people show up to your home, you might think that it would be beneficial for you to go lease a commercial space and get some signage and have your customers show up there, which would honestly be a great benefit to you. You would have foot traffic, maybe street traffic of people seeing your signage, and you'll be able to grow that business. But that being said, you're leasing it from another person, so you never actually own the asset. But what if you decided to buy that building instead? What if you decided to buy that unit? Well, technically that would make you a real estate investor. But you being a real estate investor is a lot different than many other real estate investors who are renting out to other tenants. Your tenant is technically your own
Yes.
business. It's you.
Yes.
So this is interesting. The person who is actually going to be using the space is the doctor or physician who's running an active business. So here in the tax code, the IRS has what's called grouping elections. And a grouping election means that you can group one asset to an activity, or group two assets together to form an activity. Maybe I have 2 short-term rentals and I don't want to spend 100 hours managing both short-term rentals. So I'm going to show the IRS I spent 100 hours managing one short-term rental, and I'll make a grouping election with all my other short-term rentals so I don't have to manage all of them. The IRS allows you to do this in real estate with short-term rentals and with long-term rentals. But what we just uncovered is that the IRS allows for you to do a self-rental grouping election. So for that doctor or physician that just bought that office space, they can buy that office space under an LLC and group that LLC in with their other LLC physician business or S corporation physician business and have one activity on the tax returns. Yeah, sure, the business is active, you being a doctor or physician, but the investment property is attached now by this grouping election to your active business. What does this mean for the taxpayer? Well, if that taxpayer decides to perform the cost segregation study, they get to benefit just like somebody who is a real estate professional, just like someone who spent 750 hours. That loss on the tax return from the cost segregation study is now considered an active loss, Rich, and they can use that active loss to offset the S corporation's income or offset the LLC's income.
Dude, that is so unique, man. I've never heard of this until today. What what needs to be in that group in order for it to qualify?
Yeah. So two things need to happen. One, you need to have either a commercial or a residential property, preferably a commercial property. And you need to have an active business that's incorporated, preferably an S corporation. If you decide to make this grouping election, something that you also have to be aware of is that the IRS does have what's called excess business loss limitation rules.
What does that mean?
That means that there is a limit to the amount of losses that you can take from the cost segregation study against other forms of income because you've grouped it to an active business like an S corporation, doctor, clinic, or chiropractic facility. And the excess business loss limitation rules are around about, and I'm ballparking here, about 270,000 for single members and around about 570,000 for married filing joint couples. What that means to you is if you do a cost segregation study and you have $800,000 in paper loss, you're only going to be able to claim about 560,000 if you're married, or
Per
about
year?
two
For the whole entire
per
property?
year.
Okay.
Per year.
Okay. So
Yeah.
per
So
year.
the excess losses
Yeah,
roll over.
roll over.
They
That's
roll
not a big-
over.
You'll get it eventually.
See, Rich, I love the way you think, man. I wish more people would think like you because you're like, dude, I'm about to take $550,000 in a loss here and the rest rolls over. But for some people, they're like, oh my God, I don't want to do this. Oh, well, the rest is only going to roll over till next year. But yeah, the rest is rolling over to next year. And that additional 300K that's rolling over to next year is wiping out the first $300,000 that you make in the months of January, February, and March, right?
Mm,
So you're tax-free on your first 300 grand of income.
yes.
And that's the benefit of doing the self-rental strategy is you don't have to go and run an Airbnb business. You don't have to go and qualify for real estate professional status. By making a smart investment and making a grouping election, you can perform the cost segregation study to create a paper loss.
So is there any other like avatar that would make a good candidate for this program other than like a dentist, chiropractor, or a doctor that's really going to like use the space for their own practice?
A content creator as well,
Really?
right? Because
Give me an example of that.
so let's just say that I wanted to do content, but I wanted to have a studio for doing content. And rather than leasing the studio, I wanted to own the studio. And rather than having the tenant in the studio be someone that's not me, I'm going to rent the studio myself. And now I'm going to do the self-rental rule where I group the new property that I just bought, that's going to be my film studio, with my business, which could be YouTube, Karlton Dennis, sharing YouTube content. And now I've done the self-rental strategy. I can perform the cost segregation study on that property, go ahead and create a paper loss and offset whatever income that's coming over from my LLC or S corporation. And that has nothing to do with me being a doctor or a physician. I'm simply just a content creator and buying a content creation studio.
So could I theoretically do it for this office space? I don't own it. We rent it. But if I wanted to buy this office space, could I theoretically qualify for that as well?
100%.
Yeah.
Let's just say this office space is worth $2 million. You put a down payment down on it and they give us maybe $500,000 worth of depreciation when we do a cost segregation study on this property. You would be able to claim that $500,000 of loss against your business income that you have from running your businesses.
Yeah, that's
Yep.
interesting.
Yep.
I would
Without
never,
having to go buy another
Yeah,
property and
and I-
manage it.
and for the record, I would never buy this building. It's a really nice building that we're in, but a couple reasons. One, office space right now is not a great buy in most markets. I feel like it's on the decline. But number two is this office that we're sitting in right now is part of an HOA.
Oh,
And so that
Yeah.
these buildings, you see the residential condos that are around us, there's about 240 units. And so there's an HOA that's attached to this. So what you can and cannot do is always going to be tied to the HOA. Those HOAs keep going up. So the HOA for this particular office space is about $1,200 a month, right?
okay.
And so that's going to continue to go up over time. And because of those reasons, I would never buy this. It just doesn't make sense. And if you actually do the numbers and run it, be like, okay, what would my down payment be? What would be my cash flow scenario? This thing would be negative cash flow with not much upside on the back end.
Yeah,
So for
totally
me,
get that.
I just wouldn't do it,
Yeah.
But renting, it's nice. And you can rent office space for relatively cheap right now, especially in San Diego.
And it's fully deductible without you having to come out of pocket to make a huge down payment, right? But if you do spend so much money, the government's going to give you that tax incentive, aka depreciation. And that's because you probably took out leverage and got a loan in order to buy the place.
Yep, absolutely. A quick side note, man. I want to switch gears here real quick and ask you about this. I have a lot of buddies that are, and I know a lot of females too that are realtors, and I'm always shocked by like how few realtors are actually buying investment real estate. And I'm like, dude, like you guys should be taking advantage of all this freaking real estate stuff because you're a full-time real estate professional. Is it true that if your spouse is a full-time real estate professional and you have a high-paying W-2 job that if you guys go in on a real estate investment together, that you guys will both qualify for all those tax deductions. Is that correct?
That is 100% correct.
Dude, no one talks about this.
If you file married filing jointly and your spouse is the real estate professional on the tax return, you don't have to be the real estate professional on the tax return. You can go run up the score, make as much money as you want to make, and your spouse will claim the designation for the both of you. When you perform the cost eggs or create the losses on the tax return, all of it gets to offset your W-2 or your 1099 income because your spouse decided to qualify as the real estate professional.
Okay, this is another question. So let's say when I do get married, I'm a full-time real estate professional. Will my spouse also qualify?
Your spouse will qualify because if you file married filing joint, you guys are filing a joint tax return. So the losses flow over as active losses, offsetting all forms of active income on a joint return.
Okay.
Yes.
And even if she was employed by me?
Even if she was employed by you.
Wow. Okay. That's interesting.
Yeah.
Blowing my mind, man.
And both of you guys might be real estate professionals in that sense, right? If she's employed in a real estate related business, she's putting in time in a real estate related operation. The IRS loves to see that. And if she qualifies as a real estate professional too, the both of you guys get to benefit from the losses as well.
I love that.
Yeah.
Well, I think this concludes this edition of the Saturday edition. That was not one tip, but 2 pro tips from my man, Karlton Dennis. He's Karlton Dennis. I'm Rich Summers. We got to do the yacht soon up in Newport Beach.
Would love that.
Listeners, thanks for tuning in. We'll see you in the next one. Peace.